Good morning, everyone. Thank you for attending our webinar today. Our topic is good governance of employer-sponsored group retirement plans, retirement plan design considerations, and best practices. My name is Barry Laberge, and I'm a retirement plan advisor here at SelectPath. I'm also pleased to introduce today Ryan McMurray, who is also a retirement plan advisor and is new to SelectPath. He will be servicing our clients. And so he's also on the call today. So welcome aboard, Ryan. This presentation is designed for business owners and senior managers, managers with human resource responsibilities, and retirement plan administrators. And the topic is, how are employers designing and administering their defined contribution retirement plans to produce positive outcomes for employees? In preparing the content, I was thinking about our own client base, and we have employers that range anywhere from, let's say, 10 people on a plan to 500. So in general, I'm thinking of a company with, let's say, 25 to 100 employees. Here's our agenda: retirement plan design considerations, and this is where I'm going to spend most of our time. Then I'm going to move into good governance, best practice guidelines, and then finish off with a retirement plan review meeting. The webinar should take about 40 minutes of content. The content is being recorded today. If you have questions, please put them in the chat box. The questions will not be included in the recorded version of this presentation. The presentation will be available from your SelectPath advisor and also on SelectPath's website. Let's first look at the types of plans we're speaking about today. I'm specifically looking at defined contribution plans as opposed to defined benefit plans. And there's two categories: defined contribution pension plans, which are under provincial pension plan legislation, and the legislation that applies to defined contribution plans also really comes from defined benefit plans. So there's lots of similarities in there. The second type is group registered retirement savings plans. And here the only legislation is really the Income Tax Act. And I'm thinking of a plan where there's an employer and an employee contribution made to a group RRSP account for the plan member or the employee. And an offshoot of that is a plan I like, is a deferred profit sharing plan for employer contributions and a group RRSP for plan member or employee contributions. And I'll come to that. In the industry, we use this expression, capital accumulation plans. And here the employer and the employee contributions are defined, and the retirement income is a result of how much capital is accumulated and how much income is paid out in retirement years. Let's get into the different plan provisions. So as you can see, I've created two columns: defined contribution pension plan and in the RSP and DPSP plan type. There is some similarities between the two in the outcomes of the programs. So I've tried to highlight the similarities and also the differences. First of all, let's look at who can join a plan. Most plans are voluntary. It is a good best practice, though, to have a signed waiver from an employee who chooses not to join the plan. Looking more specifically at pension plan legislation, full-time employees are eligible to join after completion of 2 years of continuous service. Now that period can be shorter. With an RRSP or DPSP structure, that provision is not necessary. There can be, I use the word discrimination amongst different employee groups. When thinking about pension plan legislation, remember the idea is that all employees in an employee class or pension plan class have to be treated equally. Another consideration with pension plans is that part-time employees are allowed to join if minimum hours worked or earnings thresholds are met over a 2-year period. So what this means, if someone works 700 hours in 2 consecutive years, they're eligible to join the pension plan. Or if they earn 35% of Canada Pension Plan yearly maximum pensionable earnings over a 2-year period, they're eligible to join the pension plan. So that works out to about $21,000 in 2021. Another consideration is connected persons. A connected person is a shareholder or a family member of a shareholder in a business. So if the person owns 10% or more in the business, they're considered a connected person. So with a defined contribution pension plan, CRA must be advised within 60 days of that person joining the plan. And this is done through a CRA form T10007. Sometimes on the enrollment form from the insurance company, it will ask about connected persons, but not everybody knows what a connected person is. Another consideration is with deferred profit sharing plans, which are employer contributions only. A connected person cannot join the plan. The workaround is that the employer contributions can go to the RRSP for that person. Let's move on to tax reporting. I want to specifically talk about this idea of saving on payroll taxes. So looking at a defined contribution pension plan and a deferred profit sharing plan, the employer contributions are not added to the employee's gross income. So the contribution is not subject to payroll taxes. And payroll taxes are government required insurance premiums, really. So Canada Pension Plan premiums, employment insurance premiums, WSIB premiums or workers' comp premiums, and employer health tax in Ontario. Whereas with the RRSP, the employer contributions are added to the employee's T4, and then it's offset by a tax receipt from the financial institution. So a group RRSP is really the same as paying the employee more in salary. So I've seen some examples where the employer can save potentially 8 to 10% on their retirement plan costs every year by having a defined contribution pension plan or a DPSP plan for the employer contributions. I've also highlighted other T4 reporting points of interest, and these are what needs to go in each box when an employer sponsors a retirement plan. Another consideration is income tax withholding, and it's the idea of benefits of upfront tax savings. And I find this is attractive to many employees. The first is that employer and employee contributions are made directly to the plan member's account with no tax withholding. So this is different than if a person is buying an RRSP on their own, let's say, outside the plan, where they have to wait to get the tax refund from CRA because of the fact they've made a contribution to an RRSP. So the point is, the money gets invested right away, and the full amount of the contribution gets invested. Another consideration is that employers can reduce the amount of tax withholding when an employee is contributing by payroll deduction. First of all, this makes it lower cost for the employee to put money in addition to the convenience of having the money coming right off their pay. An example would be this. Let's say someone was earning $2,000 every 2 weeks, and they were going to put in 5% to their retirement plan, works out to $100. They receive a tax savings at their marginal tax rate. So let's just say that's 25%. So the person's net pay, if you will, goes down by $75 to put the $100 in. But then let's say the employer also makes a matching contribution of $100. So if you add that up over a period of a year, there's $5,200 in that person's retirement plan, excluding investment growth, all for $75 per pay. Let's take a look at contribution formulas. The most common contribution formula we see is a percentage of earnings. And it can be either up to a certain percentage, for example, 1 to 5%, or a specified amount, example, 4%. With the specified amount idea, the person really has to make a yes/no decision as to whether or not they want to join the plan. So do you want to put in 4% or not? My preference is the up to structure. And here the person might start out less and then increase their contributions in the future when they can afford it. We do occasionally see fixed dollar amount formulas. This is where just a certain fixed dollar amount goes in every month or as a deduction off each pay. There's different opinions on the fairness of this type of design. It could be argued that it's fair because everybody gets the same thing. However, people who are at the higher income levels, they tend to look at it and say, well, I'm only getting 2 to 3% of my income, and I don't think that's very good. Typically with our plans, we see that there is an employer match of some sort. Some plans are employer funded only, and then the employee can make contributions on a voluntary basis. This is where the employer is saying our employees really don't want to have anything coming off their paycheck for their retirement plan. My one concern with this type of structure is there won't be enough money there in the end because not enough money is going into the program. So that's why most plans are an employer and employee matching formula. Another consideration is definition of earnings. And so here's some examples. It's base earnings only, all T4 earnings. This would include salary, overtime, commissions, and bonuses, all earnings excluding bonuses, or another definition specific to the employer. Sorry. The reason why I'm focusing on this in such detail is because I'm thinking of plan member booklets and plan text documents. In other words, what does the employee see? And for an administrator, what should be deducted off a person's pay? And does what the employee thinks they're getting line up with what the options are under the plan? So I think that's just a good governance point to review your plan documents regularly. I also think it's a good best practice that if a person doesn't take full advantage of the program, to make sure that there's a record of that on a signed document from the employee. The insurance company or where the money is going is not tracking how much the person elected to put in, even though it's on the enrollment form. They're just accepting the money based on the amount that they receive. So this will prevent a possible future problem in the future. People tend to forget they sign up for 3% or they sign up for a fixed amount, but they don't increase it in the future. And they could be potentially losing employer contributions because of that. Let's take a look at Canada Revenue Agency contribution limits. And I've separated the 3 plans here because they are definitely different. The first point is who monitors the contribution limit. With a defined contribution pension plan, it's the employer. With a deferred profit sharing plan, it's just employer contribution. So the employer is responsible for making sure that the limit is not exceeded. With an RRSP, it's ultimately the employee who is the taxpayer. And this is because the employer doesn't know what the employee's contribution limit is. That's on their employee's CRA notice of assessment. So what some employers do is they'll put a cap on the amount that they will contribute. And usually this cap is equal to 1/2 of the dollar limit for the year. What this also does is it's a cost containment measure for the employer, especially with higher income employees. If the employee does contribute too much, it's their responsibility to rectify the situation. But typically what happens is the employee, or I should say taxpayer, gets a notice that they may have over contributed. And it is cumbersome or a hassle, you could say, to try and sort this out with Canada Revenue Agency. There is a mechanism to take the money out, but if the person doesn't do it in a timely manner, they will face penalty taxes, which accumulate every month. So looking just specifically at what the limits are, with a defined contribution pension plan, the limit is 18% of the employee's current year's earned income, up to the yearly limit of $29,210. For a deferred profit sharing plan, it's 18% of the employee's current year earned income, up to the yearly limit of $14,605. And with RRSPs, it's 18% of the previous year's earned income, up to the yearly limit of $27,830. Most taxpayers who are, let's say, middle-aged have carry forward of unused room, and that's where they haven't put in maximum to their RRSP in the past. So there's lots of middle-aged people walking around with $50,000, $60,000 of carry forward room that if they had the money to put in, they could put the money into their RRSP. I want to speak a bit about benchmarks and outcomes. So when we look at benchmarks, and there's not a lot of really good information out there on benchmarks, the insurance companies do have some good information that we use. What we typically see is that the employer contribution is in the 4 to 5% range of earnings on a defined contribution plan. And what we see more often than not is that the employer matches $1 per dollar. So whatever the employee puts in, the employer will match it. The effect of that is that the employee is saving towards their retirement 8 to 10% of their annual earnings. Let's shift over to outcomes now, or creating best outcomes might be a better way of thinking about it. Employees often don't take full advantage of the company contributions initially and need to be reminded, as I said before. There's also the idea of how much should a person be saving. And if you're familiar with the wealthy barber, we know the wealthy barber said you needed to save 10% of your earnings. So language that I would say in a member meeting is save 10% of your earnings starting from a young age to have enough money for your retirement. Let's look at what happens if. Here we're looking at plan provisions specifically. So what happens if an employee wants to take their money out or transfer to another financial institution while they're still an active member with the employer, still a member of the plan? So in short, with a defined contribution pension plan, the employer and the employee contributions are locked in, so the person cannot take the money out either in cash or transfer it out. Employee voluntary contributions can be withdrawn though, and that's where the employee is putting in extra money by payroll deduction and is not receiving a company match. Looking at RRSPs, it's the employer that determines the rule. And here I'm seeing there's roughly a 50-50 split between employers that are saying we want no withdrawals or we will allow withdrawals. What has been happening over the last 10 years or so, I'd say, is that there is more of an appetite for employers to say, we want this to look more like a pension, so we will not allow in-service withdrawals. Now, the one exception to that is withdrawals made from an RRSP under CRA approved withdrawal plans, like a home buyers program. Some employers, what they'll do also is they will say, okay, we want to restrict or not allow withdrawals from our employer contributions, but we will allow withdrawals or transfers out from employee contributions. And that's all done directly with the insurance company. So the employer is not involved in the administration of that, but the employer does have to set what the rules are. They have to set that up in their plan documents that is recorded with the insurance company. The last one is a deferred profit sharing plan where it's employer contributions only. Typically, withdrawals are not allowed. The one exception can be where, let's say, the employer puts a bonus payment into the deferred profit sharing plan and wants to give the employee the right to take that money out in the future. I want to now move over to vesting. And what vesting means, it's the employee's right to the employer contributions upon termination of service or retirement, death, disability. So with a defined contribution pension plan since January of 2012, vesting is immediate. However, when a person leaves their plan, the monies are locked in under pension law, so they cannot cash them in. Looking at an RRSP, vesting is immediate. So if a person leaves, the person takes the employer's contributions. With DPSP, there is some flexibility for the employer. Vesting can be immediate, or the vesting period could be up to 2 years of plan membership. So some employers will say, okay, you're eligible to join the plan after a year of service, then you have to be on the plan for 2 years in order for you to keep the employer contributions in the event you leave. And if the employer contributions are not vested, the employer can use the refund, either take it in cash or use it against future contributions for other employees. Let's look at what happens when a person leaves a plan. Let's focus on pension plans first. So when a person leaves, the money is typically transferred to a locked-in retirement account, and the employee chooses where those funds will be kept. Monies cannot be forced out of a pension plan, though. So the employee really has to make that election. What's happening now is when people are over age 55, or more realistically, when they want to start converting their funds into income, though, most will elect to unlock up to 50% of their locked-in funds, and they have to do that within 60 days of creating income. So the effect of that is locked-in money, which was originally intended to provide pension income for life, or pension income that the person would not be able to spend in its entirety prior to the age of 90. That idea in practice really isn't happening, because people can unlock up to half of their money, transfer to an RSP, take it out in cash, or put it in a registered retirement income fund. There are other instances when a person leaves their pension plan and their monies are locked in, that they can unlock the funds. For example, if it's financial hardship situation where a person knows for the next 12 months they will have low expected earnings, or if they're going to lose their house or they won't be able to pay their rent, it's possible they can unlock some of their funds by filing a form with the provincial regulator. Someone who's age 65 and retires, typically the small amount is about $25,000 to $30,000. So when the person receives their options letter from the insurance company, they'll see that their funds are not locked in under pension legislation. So they can transfer to an RSP if they want, or take it out in cash over a period of time. With an RSP or a DPSP, when a person leaves, the funds are transferred to their RSP. Oftentimes, this is an automatic transfer with a lot of the insurance companies. So the person is effectively forced out of the plan either immediately or within a 90-day period if they do not respond to their options letter. Or the person can take the funds out in cash and report the taxable income. The last point I want to cover is what happens if an employee enrolls on a plan but does not specify an investment option. And this is called the default investment option. The default investment option is chosen by the employer or plan sponsor. And what we see now is the most common default option is target date portfolios, sometimes called life cycle funds or retirement date funds. And the idea behind this is the person goes into a fund based on their age. And then as they age, become older, the portfolio becomes less risky. In other words, it shifts more to a fixed income weighting as opposed to equity. We call it a set it and forget it strategy. And it encourages an employee to enroll as soon as possible without having to make an investment decision. I'm now going to look at a different topic, which is the capital accumulation plan guidelines. And this is the responsibilities of the CAP sponsor or the employer, the plan members, and also service providers. First of all, where did the capital accumulation plan guidelines came from? They first came out in 2004. And this is back when many large organizations were changing their defined benefit pension plan into a defined contribution plan. So the employee was shifting from a pension which they knew that they would get a certain amount of income in the future based on their years of service with the employer or as a member of the plan and their earnings. And then they were being told, well, no, it's not like that anymore. Now it's up to you to plan, save, and invest for your future. So you'll control the investments. So that was a concern for the regulators and also the financial institutions. So the guidelines were created for plan sponsors and employers. And you can see I've highlighted the key points of what the plan sponsors' responsibilities are. It's really just set the plan up and then provide investment information and decision-making tools to the capital accumulation plan members, providing ongoing communication, overseeing the plan, and then making sure that when the person leaves their employ, that the options are clear to that person on what they have to do next. The plan member, though, has very specific responsibilities also, and it's their responsibility to use the information that they have available to them and then also make the right investment decision. So they have to decide how much to contribute, where they should put their money, and should they change it in the future. A lot of the responsibilities that the CAP sponsor has can be delegated to a service provider, though, and typically this is a life insurance company record keeper. My opinion is the insurance companies do a really good job of being compliant with the capital accumulation plan guidelines. I can see this just in the statements that go out to plan members. It reminds them that they do have responsibilities here. There's financial planning tools, there's projections on retirement income, good transparency on investment funds, what are the fees, what are the returns, that type of thing. So the CAP sponsor has the responsibility of just ensuring that information gets to the plan member. And the service provider will ensure that it's written in plain language. A good best practice for a CAP sponsor, though, is to review the plan periodically, once a year or every few years, and just to do a capital accumulation plan guideline review, just so that the sponsor is confident about what the plan members are seeing. The guidelines also suggest that the plan members should decide if they should seek advice outside of their retirement plan. So some people will do this if they feel they need it. Also, the retirement plan might have resources for the employee to use. It could be the plan advisor, or it could be a financial education specialist from the record keeper who is available to speak to a plan member if they want some support. This is an excerpt from an employee communication or a meeting that I've done in the past. And the idea is to advise employees that they have to take control of their retirement. So it outlines who does what. So they can see that the employer's job is to pick the record keeper, make sure the contributions are sent in, review the plan periodically, and to provide information. The information could be a plan rules document. Then the plan member has to understand their plan and their investments, choose the investments, make the contributions, monitor their account, update personal information, which is important. That's beneficiaries and addresses. A lot of that can be done online now. And then, as I said before, decide if they want to get some outside advice. I'm now going to move on to pension plan governance specifically and talk about a couple of things. So this applies to pension plans. So this is defined benefit pension plans and also defined contribution pension plans. The Canadian Association of Pension Supervisory Authorities, they don't regulate group RRSPs, but the spirit of what they're saying is worthwhile reviewing. The key thing is guideline number 4, which is pension plan governance, which came out from the regulator in December 2016. The regulator in Ontario, for example, would be the Financial Services Regulatory Authority, formerly known as FSCO. And the key is that the plan administrator has a fiduciary responsibility for overseeing the plan. And in the defined benefit world, this is really important because the regulators want to ensure that administrators know that although an employer might have personnel who's responsible for making business decisions, the decisions they make on the pension plan also have to be considered. So it's this idea of two hats, and that they are looking after the employee's future pension. So I think the key word here is a pension promise. You definitely see that with a defined benefit plan. With a defined contribution plan, it's more about making sure that what was intended with the plan design is consistent with what the pension plan documents are, and also adhering to pension plan legislation. So the regulatory authorities think it's really important that governance be monitored within a particular employer. So what they've come out with is an assessment tool. So in BC and Alberta, now when an employer or an administrator, let's say, files their annual information return, a question pops up and says, well, have you done an assessment of your pension plan as you're required to do every 3 years? And the assessment will cover the 11 principles of good governance. So the regulators do have a questionnaire that can be adapted for an employer to use, and the insurance companies have also started to develop these. The regulators also came out with pension guideline number 8, which came out in February 2019. And really the guidelines simply said that the capital accumulation plan guidelines that came out in 2004 are still valid, and that employers have responsibilities to make sure that their employees understand what their responsibilities are with respect to their defined contribution pension plan. What I have seen in the communications from the regulators is there's now more emphasis being placed on retirement income outcomes from a pension plan. It's no longer just making the right investment. It's more about how much income will you receive when it's time to convert your funds into a retirement income investment, whether that's a registered retirement income fund, or more specifically to pensions, a life income fund. And does the plan member have tools or information on their statement that makes it easy to understand how much will they get? What do they have to do? My last point is on a plan review meeting. And this one slide is what happens in a plan review meeting. So a plan review meeting, it's a periodic plan review, and usually the record keeper is there, a representative from the insurance company, the plan advisor, and then hopefully from the employer, there'll be a senior management person or the business owner, let's say, and these folks might not have day-to-day responsibilities with respect to the retirement plan, but they are the ones who can make the decisions. Sometimes these senior management people are not even Canadian. The plan could be administered out of the US. And it's, as I said, it's important that the retirement plan administrator, the people who do the day-to-day work, are also in attendance at a meeting like this, just to catch the details. So let's take a look at what would be spoken about. A review of the plan rules. What does a member booklet look like? Is there a plan rules document, let's say a one-page summary that would go to an employee? And is the plan being administered in a way that lines up with these documents? Take a look at the investments. And here we're not looking so much at individual accounts, but more, what are the rates of return on the various funds? How are they performing versus benchmarks? Then also investment management fees. Is there an opportunity due to the plan having grown to possibly reduce the investment management fees for the employees? This will lead to higher investment rates of return, net of fees. And then also look at how are plan members investing. Take a look at demographics. Can we see that there's older people who are investing, let's say, in growth or aggressive funds? Are there younger people who are possibly in guaranteed investments or conservative funds? And in today's low interest rate environment, they're simply not going to make enough, but that's what they chose, or for whatever reason, that's why they're in a particular fund. So it's trying to catch those things and then trying to develop communication strategies, whether it's to a person individually or just on a more group basis, to nudge people in a different direction. Take a look at the record keeper tools and services. Are people using the call center? Are they using the website? What can be done to encourage a person to sign up for online access to their account, use the tools that are available to them? What are the tools? Can a person determine how much income they're going to get from their retirement plan as they approach retirement using a tool that's available to them in their online access? And then try to see if there's any plan member education opportunities, whether this is an insurance company, financial education specialist coming to do a meeting or a webinar, or if it's the plan advisor offering to do a meeting. Possibly it's geared towards specific groups in the meeting based on age. Is there an opportunity for the plan advisor to meet one-on-one on site with individuals? The last thing that comes up is legislation matters. For example, Canada Revenue Agency contribution limits. I just want to touch briefly on pension plan annual filings, which do not apply to group RSPs, but definitely apply to defined contribution pension plans. There is a filing that is due every year, 6 months after the plan anniversary. The regulator will send an email to the plan administrator 2 months prior to the deadline to remind them, and then another reminder email 2 weeks prior to the deadline. Sometimes the email doesn't go through, ends up in a junk folder. Sometimes the person who was the plan administrator on file with the regulator is no longer there. It's important that the person who is on file with the regulator also delegates other people in their firm who possibly could actually be doing the annual information return, which is online. They cannot share passwords. It will create all kinds of problems. If for whatever reason it's left to the last minute, it's easy to get an extension if you have online access, and you get an extension for another 2 months. But the key is the filing has to be done. The penalties are significant. It's about $2,500. So the last consideration is pension plan amendments. So if a pension plan is changed, the contribution formula is changed, let's say, or the description of classes and the way it's being administered, it's important that the regulator be advised within 60 days. So in closing, this is an excerpt from a plan member meeting that I've done, and it's just the message that I try to get across to end up with the best outcome. So the message to the employees is to get started early, make sure you're saving enough, make the right investment choice, and don't take the money out. So with that, I don't have anything else to cover today. Thank you for your attendance. On behalf of Ryan and the other advisors here at SelectPath, thank you for coming.